So a few weeks ago, I was in charge of cooking out, making dinner, and my fiance was inside. She was making all the mixed vegetables. So she said, "Hey, could you put on the gas grill and warm it up?" And I said, "Sure." So I put on the gas grill and I warmed it up. She goes, "Okay, we're going to be eating at 6:30." I said, "Okay, great." Well, I went upstairs and I started doing some research on stocks, and pretty soon I forgot that it was about 6:15, and she calls up and she says, "Hey, did you put those steaks on?" And I ran down and I'm realizing, oh man, I'm going to be late for dinner. The steaks are going to be a little bit later. And meantime, she's got the vegetables cooking in the kitchen. They're going to come out at 6:30. So what happens to me? I either have a steak that comes out on time, or I either pull it off a little too early, if I'd put it on earlier, or I pull it off a little too late. So the idea is to be able to time that steak so that it comes out at exactly 6:30, so that everybody's happy and you have a good meal. You pull it off too early, the steak gets cold. You pull it off too late, your meal is not ideal. What the heck am I talking about? What does that have to do with anything? Well, there's a right time to buy and a right time to sell in any stock and any investment. And if you can time it right, you get a much better result than if you just buy anytime. There's a perfect spot on the chart that you have your best odds to buy, and a perfect spot on the chart where you have your best odds to sell. And this charts will tell you all of that information. So it's really important not to just pick a stock and choose something to buy, but to make sure that you choose it, and you choose it at the right time and buy it at the right time and sell it at the right time. So with that, let's talk about my favorite buy patterns. Well, I have three of them that are my favorite buy patterns, and they kind of cross over to each other. The first one is a cup formation, and you'll see what that is in a minute. The next one is a consolidation pattern, and then finally a double bottom. These are three patterns that happen most of the time and give you a lot of odds of buying properly. A cup formation. The one on the left here is a cup that has, a pretty nice rounded bottom. We kind of like rounded bottom. And when you get a nice rounded bottom, it means generally there's an orderly sell-off and then there's an orderly buyback. And depending on your volume, that's going to be where you're going to want to try to decide where your best spot to buy is. Generally, your best spot to buy in a cup is at the top of the left-hand side of the cup when it kind of reaches there and it goes up on good volume. That's generally where your best time to buy is. I have some nuances on that I'll talk about in a different video, but let's just assume for now that that is your pivot point. The pivot point being the best point on the chart at that time to buy. You also have a cup with handle. Notice, this isn't my favorite cup with handle, but it'll do. It's not as rounded as I would like. It's got a little jag in the middle there. It should be kind of rounded, so there's orderly buying and selling all the way down and all the way back up. And then it kind of comes to the top of its cup over here, and then it has a handle. Now the handle is generally a low volume sell-off that doesn't go on for too long. It shakes out all the people that made this money on the way up, but since it's not very high in volume, you basically, it's telling you that the institutions are continuing to buy. And so they're not going to let it fall down too much lower than that spot on that handle. And then the top of the handle is generally where you're going to want to, make your acquisition, make your purchase, something like that. So you got a cup with handle and a cup. I kind of use them both interchangeably. The handle just seems to be a little bit better when it comes to predicting whether it's going to be a good breakout point or not. Because we like to buy when the trend is our friend. We like to buy when stocks are on our way up. We don't want to be buying over here on the left side when, it's down 20% and maybe we can catch the bottom. Because if you try to catch the bottom of a stock, you end up having to ride it down another, say, 20%. And you want to get it when people are buying it, not when people are selling it and you're trying to get the best price. That's not your best odds. Consolidations are generally about 80% of the time a stock is consolidating. The rest of the time it's breaking out. And so the consolidations you want to watch very carefully. And sometimes you have a cup inside a consolidation, but generally it just means an accumulation within a range. And when you have an accumulation in a range, that means there's orderly buying, orderly selling, and they're just waiting for the next time the stock has an opportunity to break out. Could break down, it could break up, but that's generally what happens out of a consolidation after a long period of time. So in this consolidation, you see the upper range and you see the lower range. And when you see those ranges, it's just basically telling you the stock likes to be in that range. Now, you can look at a tighter chart. This is a weekly. If you look at a tighter chart, you might get consolidations over a tighter period of, a tighter range. But generally, it's your highs and your lows, your big swing points, and everything else is contained in there, and you want to try to buy when it's breaking out of there. So there's your consolidation. All right, double bottoms. Double bottom generally means exactly what it sounds like. Now, here's the key of double bottoms. You have a sell-off, then you have a buyback. Now, that looks like a cup, maybe even a cup with a handle. And it is. And then you have another sell-off. Now, this sell-off is basically to shake out those weak holders, those people that couldn't hang on to the stock because they thought it was going to break out and they were wrong, so they're just going to get rid of it. Now, if you have a double bottom, especially if it's like that handle where it's a low volume, that's kind of healthy. But generally, you're going to have a bigger sell-off down a little bit lower than where the bottom of that left side of the W was. So you got two sides of the W, the peak at the bottom and the peak at the right side, on the left side and the right side. Sorry about that. And then your goal is when that stock starts to recover, you want to buy it just when it's breaking out at the top of the middle peak in the middle of the W. So the apex in the W right here is your breakout point. So when you get some good volume, and on this chart you see the good volume, third from the right, that's a good time to buy that stock. That means institutions are bidding it up. They're going to be chasing it. People are going to be chasing it, wondering why they didn't buy it earlier, and that's where you're going to want to be buying it. Those are the three patterns that I look at. When you spread this out on a daily, this is what it looks like. So it happens over time. You get your left side decline, a recovery, another decline, and it's going to be a little bit lower than that left side of the W where it is on the right side of the W. And then once you get that, you get a capitulation. And that capitulation basically means that everybody's had it, the sellers are out of it, and it's time to buy. And notice on this chart how many days in a row the stock was blue, which basically means the stock was higher than its prior close. Now, in a couple of them, not much higher, but that stock was blue for a long period of time and then finally broke out and kept going and went right out of its buy range very quickly. What is an early stage? Well, an early stage is when you buy a stock in the first or second stage. Generally, stocks that break out in later stage bases have a tendency of having failed breakouts, whereas stocks that you can buy in earlier stage bases, stage 1, stage 2, those are stages where, okay, there's a lot of interest in them, and there's not a lot of sellers that are in the stock yet because it hasn't gone up enough to have people start to panic about losing their profit. So if you can get in on a stock that's looking healthy, that's got good fundamentals, that's got a good pattern, and you can get in on it at an early stage base, stage 1 or stage 2, you have a much higher probability of making money over the long term. So it's really key. Looking at this chart here of DirecTV, you'll see there's a stage 1 consolidation where it stays in a range for many, many, many months, more than a year actually. And of course there were opportunities to make money in here, but it's not your best opportunities. That stock was basically going sideways for a long period of time. It looks like from about 40 to 55 for a long period of time. Not a huge amount of opportunity, especially if you don't know where to buy it. There wasn't any clear spot to buy it. But on the right side of the chart, you now have a double bottom, shaking out the weak holders all the way on the right, and that stock has a breakout on high volume. And notice how that's a healthy breakout because it's an early stage base. So you have a base on base pattern, so that's why they're still called stage 1. Stage 1 means stage 1 means an early base, and then base on base means that you have one base on top of another one, which is great because you have two patterns setting up together. Looking at Lennar Corporation, here's a situation where there's lots of bases on top of each other, and the stock did really well. And if you had looked in this flat period on the left side of the chart, you would have seen there's many opportunities to buy the stock. But it doesn't really have a terrific breakout because it's still kind of trading in a range until that second stage base, which is still a good time to buy it, and then it breaks out. And now you'll look at these third stage bases and fourth stage bases building on each other. They still make money, and this just happened to be because the sector itself was just on fire. And whenever it went down, people just got back into it and kept bidding the stock up. Doesn't always happen. And these later stage bases are riskier, as you'll see in some later charts. Now, looking at Chipotle Mexican Grill, had beautiful early stage bases here on the left. And if you had bought there on the left, you'd have done really well, because if you would have been able to hold it from that $98 point all the way up into the top where it got to say 400, that's a pretty good return. And there weren't too many large corrections along the way. It basically hugged its 50-day moving average. However, if you'd started buying this stock in the later stage, in the stage 3 over here and later, now even though this stock is still creeping up, it's creeping up on lower volume, and that means there's not a lot of buyers. And as soon as the selling starts, look at that volume on the right side of the chart. It just increases substantially, and now you're stuck in a stock that went from 400 to 230 if you held it all the way and didn't have a good sell rule. So you want to make sure that you're buying in early stage bases, because you have a better chance, even though this one shows you still can make money in the third stage. You just are taking on a lot more risk to do it. There's lots of stocks out there. You might as well pick ones that give you your best probability. 3D Systems, one of the great performers of 2012, and if you look at this chart, you'll see why. After a long consolidation, it has a stage 1 cup, and it breaks out of that cup on good volume, and the stock really never looks back. It has one correction in the middle that you can see there, and that just happens to be a third stage base. Now, if you bought it there, you'd have done still pretty well, but you started to take on risk, and boy, look at the risk. It round tripped from that cup all the way back around. So if you bought it on that breakout and you held it all the way up and you held it all the way back down to the 200-day moving average there, or the 40-week moving average, you would have basically broken even. Now, if you had a good sell rule on your profit or a sell rule on your stop loss, then you would have been okay. But still, why buy a stock in the third stage base when that's its riskiest time? So here's our rule. Only buy early bases, stage 1 or stage 2. Never buy a later stage base. And by the way, let me back up and talk about what a base is. A base is one of those patterns that we talked about. It's a double bottom, or a base can be a consolidation, a cup, or a cup with handle. There are other ones too, but those are just the most prevalent ones. If you have those bases on top of each other, which means they haven't climbed more than 20%, then you're not changing the base count. All you're doing is adding on to that base. So it's called a base on base pattern. Once it goes up more than 20%, you're starting a new base, which goes to the next stage, another 20%, the next stage. So it goes 1, 2, 3. That means you're doing really well, but it's getting riskier. So we only want to buy stages 1 and stages 2 in the base count. Now let's talk about why a 50-day moving average is so important. This is the average. Now on a weekly chart, we're going to call it a 10-week moving average. But on a daily chart, it's obviously a 50-day moving average. About the same thing. If you have 5 days in a week and you have 10 weeks, that's 50 days. Same thing, roughly. So the 50-day moving average, we like to look at weekly charts. Bill O'Neill from Investors Business Daily looks at weekly charts and just believes that they're easier to read. And if you could start reading dailies, that's great, but there's a little bit more noise in those dailies. And as you go down in time frame, hourlies and 5-minute charts, there's much more noise in those as well. So if you can start to read weekly charts, and this is a service that we use called MarketSmith, and we highly recommend that you get it. If you look at these charts, you'll see, wow, some of these stocks really adhere to that 50-day moving average. It's so important. And why does that happen? Well, it's kind of a self-fulfilling prophecy. If every institution, or if most institutions start to follow this rule, then the stock starts to follow the rule along with it. So if they are buying stocks as they bounce their 50-day moving average, if they're bouncing off that, then the institutions are buying all at the same time and helping it go back up. So when a stock adheres to its 50-day moving average, it's very telling. It's also telling on the downside, but that's a subject for another video on short selling. So looking at this stock at FleetCor, you see, boy, it really hugs its 50-day moving average. It's 10-week moving average on this chart. It really likes it. It abides by it, essentially. You don't see one single drop below the 50-day moving average, the 10-week moving average on the right side of the chart. You do see them on the left, and then in that first cup, the stock totally changes character. Totally changes character in cup 1B, actually. So your goal is to find uptrending stocks that are going to be going up, and that means they have probably pretty good fundamentals, or there's some new invention they've got that's interesting, and they're going to respect that 50-day moving average. Take a look at the stock here. Cree respected its 50-day moving average here on the left, all the way up, and then totally changed character. Notice how the late stage of the base it is, stage 3. Stock changed character, and did it experience a huge, huge decline. So you don't want to be holding through all that. You want to use a 7% stop loss rule and get out of that stock when you're down more than 7%. So notice on the other side, as it went back down, it still abided by its 50-day moving average. It just couldn't now break above it very easily. It had a lot of trouble breaking above it until all those sellers came out basically in September of 12, and then you had a breakout from an early stage base again. All the base counts got reset, and the stock wanted to go higher. The sellers were gone, and now the institutions were back interested in the stock, and the stock went up incredibly and more than doubled there. And then when it was doubling, notice how it's adhering to that 50-day moving average. Uncanny. Even the weeks it closed below it, the next week, the institution said, nope, we can't have it down here. Let's push it back up above the 10-week moving average. That's showing you that there's a late stage base failure. All right. So there's also a time that you want to add. Now we have a whole video set up for buying properly. And the whole key to investing properly is buying properly as well and adding to your position on the way up. Most people will average down on a losing stock because if they loved it at 20, they're really going to love it at 15. And boy, when it goes to 10 and now it's cut in half, 50%, oh, they got to pile on more because it's such a great stock that it's got to come back. Well, I can tell you, folks, a lot of stocks do not come back. They stay down forever or they go out of business. And there's usually a reason a stock goes down 50%. So you don't want to try to catch that falling knife. You want to buy stocks on their way up. And then when you're buying them on the way up, it's not enough just to buy one stock and just watch it forever. The idea is to pyramid into that stock more and more and more. So we'll talk about that just a little bit. But we'll talk about add points. There's a spot on the chart where you can add safely and you have your lowest risk, and you have less risk of blowing up the whole position. So we want to average up in general when you're bullish, and you don't want to average down. You want to kind of make that a rule. We don't average down here. We average up. We pyramid that position. So here are the add points. Tight patterns, and that's when a stock is within a 1% range from its closing the day before, the week before. So when it's exhibiting a nice tight pattern, that's telling you that institutions aren't letting it go too low. Healthy bounces off the 10-week moving average, and healthy is the key word there. And then pivot points in an early stage base, which we talked about earlier, about how to get in an early stage base. But now, getting in on those pivot points and adding on those second stage base and the other bases on basis, we can add safely there as well. So what the heck am I talking about? Well, here's a tight pattern. If you look closely, you'll see these little blue dots. And we're not talking about the cleanser, Ajax. We're talking about the blue dots on the chart. And the blue dots just basically say there's a tight pattern, a very close pattern, closely closing pattern where it closed the same or within 1% or so of the week before. And if you get longer periods like that, that means the institutions are just letting it hang there. If it sells, they keep buying it and they just keep accumulating that stock. And tight patterns are really great indications that you're not going to get hurt too bad if you continue to buy there. Now, it does happen. Obviously, if you look at this chart with the 3 arrows on the right, there was a correction after some tight patterns. The stock did come back and was able to recover its 10-week moving average. But notice it's also kind of in a late stage base. So there's tight patterns earlier in the base count as well. And those were all very good spots to add. See some of these spots here, some of these breakouts, and then the tight patterns that are next to them. Those are all good add points. Healthy bounces off a 10-week moving average basically means that there's institutions that are trying to keep that stock above the 10-week moving average. When it falls below, you'll see a higher volume week come after it, and institutions will say, nope, we're not letting it go below. And so looking at these little yellow dots all over the screen, you see lots of spots where institutions are saying, nope, it can drop to that 50-day or that 10-week moving average, but we're not letting it go below. So we're going to keep propping it up. In fact, we're going to buy more because they're giving us an opportunity to buy this stock on sale. Now here's just an analysis of some stocks, and we'll walk through. This base failed over here on the left because it never had a proper breakout. Now this next cup, it had a kind of an irregular cup, which I'm not thrilled with, but in this case it worked. It had a good breakout here on volume. You saw the stock go up, correct below the 10-week moving average, and then immediately get fixed and have a healthy bounce off that 10-week moving average, this big bar here. And then it hugged its 10-week moving average for quite a while, had a couple of closes below, but it tried to recover right after that on decent volume. Another tight pattern in there. And then it had another failed breakout, and failed because it didn't have high volume, and so the sellers were easily able to come in and drive it back down. But it didn't fail too long. It touched the 10-week moving average and bounced right back up, another healthy bounce. Consolidated for a little bit, had a tight weak pattern right after that breakout there, which is another healthy breakout you can see from the volume below. And now we're getting in the late stage, but lots of tight patterns, and the institutions are basically saying, look, we're not letting it go down until there's no way they can handle that. They can't hold it up anymore. The volume increases, and there starts to become a sell. And once that sell comes in, it's really tough to keep buying because the stage is late. And so you see that the stock basically starts to get tighter, which is a healthy thing, but it slightly changes character too. And then it kind of flattens out. You don't have as big of advances. So that's essentially what has happened in that stock. It's still going higher on this chart, no doubt about that. It's just getting riskier to buy. Also, there are some spots on the chart where you want to sell. If you can't get out of a stock and you end up riding it down 100% or 50%, boy, you just blew all that profit. So you want to be able to take some of that off the table. Here are some sell rules that are very key to our trading. Never violate this one. Always sell 7% or 8% below your buy point. Statistics just show, I know it doesn't feel right, but statistics show that if a stock declines more than 7 or 8%, it's going to decline a lot further. Yeah, they recover, and a lot of times they recover quickly, but most of the time when it goes down 7 or 8%, it is either making a new cup, and cups can be 29, 50% deep. You don't want to be holding through that. It's very painful to hold through a 50% correction. Now you need a 100% repair move to be able to make back your 50% loss. So it's better just to get out of the stock and buy it when it's going back up, not when it's on its way down. Sell if a stock is living below its 10-week moving average on high volume. If you get a lot of volume below the 10-week moving average and it's not going back up over that, that's not a healthy sign. You want to sell that stock. You want to sell all of your stock if it violates a 40-week moving average on big volume. So if it drops below that 200-day moving average, that 40-week moving average, and there's a lot of volume and a lot of selling, something is wrong with the stock. Take your chips and go home. Another rule is to lock in your profits of 20 to 25% when you can, but the goal we always have is to try to find one stock that's going to change your life. So if you're just cutting off all of the buds as they come out of the ground, you're never going to get the bloom. So you have to make sure that you let those stocks that want to keep going higher go higher. But if there's a 20 to 25% chance to take a profit, you want to be looking for an exit strategy. But if you can, and there's good volume and it's still showing you spots on the chart where it's not declining but it's increasing, you want to try to ride that, and you might even add to it. But by and large, 8 out of 10 times, you're going to find a stock that goes up 20 to 25%, and you're going to take that profit off the table. Now, what does that look like? First of all, it's a 3-to-1 if you use the 7% rule, right? So a 7% loss and a 20 to 25% gain, that's roughly 3 plus times 7. So it's 21, 22, 23. So you've got 3 times more profit when you make a profit versus your 1 loss when you make a loss. So it's a 1-to-3 ratio. It's generally a very healthy ratio to use in trading. If you stick to it all the time, buy right, and you buy the right stocks, generally 3 out of 4 times you're going to be making money. 1 time you're going to be losing. And that's okay. That's good. And when you lose small. Never let a substantial profit or a good profit turn into a loss. Don't ever round trip a position. Don't be up in a position a bunch of percentages and give that percentages all back saying the magic words, it'll come back. Because a lot of times they don't come back. So don't let a substantial profit turn into a loss. Even if it's 15% or 20% and you haven't taken it off the table, take it off the table. Don't let it turn into a loss. Putting it all together. Here's what we like to do. We like to buy a 50% position at the proper buy points. And we have a whole video series on buying, selling, and putting a whole money management strategy together. But just generally, we buy a 50% position at the proper buy points. We build a full position. That's our goal, is to build a full position. So we're going to add 30% and 20%. So let's say that we have 100,000 and we want to have 2 positions. Well, basically, we want 50,000 in each position as our ultimate goal. However, we want to take that one position in a stock and cut it in half for that first buy point. So we want to put 25,000 into that first position. Then we want to take the other 30% of the 50,000 and buy another position. And then finally, we want to tap on a little bit, 20% of that position, or roughly $10,000. So that's our goal, is we want to add slowly, and we don't want to average our price too high up, because then if we have a correction, we lose all of our profit. We want to pyramid into that position. So we start with a 50% position. If it keeps going green and goes in our favor, we add 30% at the right point, add 20%. So the goal is not to get our average cost higher than 5% above that breakout point. This is the art. Then we buy another 50% position at the first proper add point. Not a full position, because then you're averaging your cost way too high. One correction wipes everything out. But buy another half position, buy another 30% position at subsequent add points. So now hopefully the stock is going up, your account is increasing, you have extra money to be able to buy those other positions at those add points. And so you're not really having to go out on margin, but if you want to go out on margin, that's okay. Ideally, though, the house is paying for your positions because your account value is growing so quickly. Then you want to start a new position at a new early stage base. So once you get another cup or consolidation, as long as it's not a late stage base, there's a good chance that you can start a new position. So it's back to the top then, another 50%, then 30%, then 20%, until you get that full position, as long as it's not averaging more than 5% above the proper breakout point. And then to wrap the whole thing up, you always want to stick to your sell rules. You start to make some good money on your positions, look at that 20 to 25% sell rule, or keep adding to that position if it's telling you that the stock continues to go higher. So what would that have done? Let's take a look at how that would look in this particular stock. All right. So you're seeing all these letters on here, and these letters are going to correspond to a chart on the next page. Sorry, I can't put them both up on the same page so you can see exactly what we're doing. But basically, these are initial positions and add-on points, and then we have a couple of sell points here that are below the line. But these are generally add-on points. This ABC means you're starting a new position, and this ABC means you're starting a new position, and all the other D, E, and Fs are add-ons to that position. Let's see what that would look like. Well, there's 2 methods we use. Number 1, we use the position stop method. Now, the position stop method says that every position you get into, you will put a stop order in at 7% below that position price. So that if it declines, not the average cost, but if that position that you buy declines more than 7%, you're out of there. So if you buy a stock at $10 and it goes down to $7, sorry, that's 30%. And if it goes down to $9.30, you're out of there. If you pyramid on top of that and you buy another stock at 12, well, you're going to sell that 12 position 7% down, but you may not touch the $10 position. Does that make sense? So looking at this, starting at the left on the top side on April Fool's Day, April 1st, 2011, on that previous chart, we start with a 50 share position. Line A, and the reason we did that, it's a breakout from the pivot. So we got in 50 shares. Our running cost is whatever the running cost is, and it shows the average cost, your average stop, and then a position stop, which in this case is the same thing because we only have one position. Then over on the right side, you'll see what the running profit and loss of the entire portfolio is on this stock, if you had just stuck to this one stock and this strategy. The next line is April 8th. Now you're going to do an add-on build position. So you see the reasons build there. And you're building because now it's still within that 5%. You're adding another 30 shares at an average cost of $260.42. And now you're starting to see your running P&L going up. Line C, now you get a full position. You've built a full position here. Your average cost there is $261. Now you're up $573. You're not even thinking about losing money, right? Then there's an add-on point later on, the tight position. You add another 50 shares. And so you can see, I'm not going to go over every line. If you want to pause the video, you certainly can and analyze what this looks like. Then because of the position stops, line D and E, those are red, you're seeing those violated those position stops, and we ended up having to sell. We sold those, but we didn't sell the whole position. We just sold those new ones, and so on, all the way down until you get to March 27th of 2013, which is roughly a 2-year holding period, just about a 2-year holding period. And you're seeing your average price there at the bottom in the green, $540. You end up with a running total number of shares. You've had some sell-offs in there, 450 shares. All the way to the right, you can see that the running profit and loss was $89,000 on this particular strategy. And you're up 58%. Now you're up 58%, and it's a pretty safe position because you've done pretty well over a 2-year period. You've certainly beaten the S&P 500, and you've pyramided your stock, reducing your risk. If we use the average stop method, which basically just says once we buy these stocks and we add on, we basically average our position to get an average price, and we subtract 7% from that, and that 7% is our stop value. If it hits that, we sell the whole position. Let's see what that would look like. You'll see it looks very similar. We started off on the left side there, and 1st of April, and we started adding our position. But what ended up happening is we didn't sell out of those stocks because it never triggered the 7% stop rule from our average price. So if you look to the position stop, you'll see that might have been violated, but the average stop didn't get violated. Notice how, let's see, on line 4, the average stop is 249, the position stop is 260. And you'll see if you go to the second to the last line on April 6, 2012, your position stop is 398 on that last position, but your average price is 307. So we essentially always pyramided up in this particular stock, and we never sold any because it never triggered the 7% sell rule. So that's a different way to play it. If you had done that, instead of making whatever it was, 86,000 before, you ended up making 118,000. Percentage return, because you have more invested, is not too much higher. It's 61%, or roughly 30% a year. However, you made a lot more money because you were able to pyramid. Your average price was 7% down, and it was never violated. So if you want to look at this, you can stop the video and take a look at this further to analyze what would have happened. But let's just summarize. So the goal is to buy early in the stage. You don't want to buy that late stage. Buy early and buy often. Keep adding to your position when you're seeing some success. Average up, not down. Use patterns to determine buy points, because those are your lowest risk, is buying at the proper buy points and adding at the proper add points. And using the patterns to determine when you do that helps you stick to that rule rather than just winging it and buying it whenever you feel like doing it. Stick to your sell rules. If you got a stock that's not healthy, it's not acting right, get out, especially if it triggers your 7% sell rule or your 20 to 25% sell rule. It's okay to take a 20 to 25% gain. And 8 out of 10 times you're going to want to do that, because those 20 to 25% gains is when the institutions start to come in and sell, unless there's a lot of buying, and your goal is then to find that one stock and ride it for all it's worth. Let the house buy some of your shares. As your stock goes up, your portfolio gains value. Let that gain finance some of the additional shares that you add to your portfolio. And when the steak starts to burn, take it off the grill.